13%. That is what prediction markets currently assign to gold reaching $5,100 in May. In the past 24 hours alone, that probability moved from 11 to 13, a 2.5-point surge. The algorithm will not surface for you. A net buy signal from smart money traders. 3 data points that feel almost clandestine in their precision. Together, they tell a story most macro investors are not reading. This is what is being priced in the gold market right now. The headline anchoring Thursday's gold coverage was, on its surface, a contradiction. Gold gained ground, and it did so on a day when United States Treasury yields were rising. That combination, to anyone schooled in the traditional mechanics of monetary policy, should not happen. Rising yields increase the opportunity cost of holding non-yielding assets. Gold pays no coupon, no dividend, no interest. When the 10-year Treasury climbs, capital tends to rotate away from gold and toward fixed income. That is the textbook relationship. And yet, here, gold defied it. What this decoupling signals is a deeper shift in macro risk appetite. Investors are buying gold not as a yield substitute but as insurance against something the bond market cannot fully hedge: geopolitical fragmentation, dollar credibility concerns, the possibility that the Federal Reserve's rate path is materially less certain than official guidance implies. The prediction market reflected this recalibration before most financial headlines had framed it. A 2.5 percentage point move on a contract asking whether gold reaches $5,100 in May is not noise. That is a directional statement. Let us be precise about what a 2.5-point probability move actually represents. The contract began the session priced at roughly 11%. It ended at 13%. In absolute terms, that is a modest shift. In relative terms, a 23% increase in the implied probability of gold reaching a target that would require a further climb from current levels, it is meaningful. What makes it more interesting is the context. Zero trading volume and zero liquidity in the contract itself. When a probability moves without volume, the signal is not coming from transactional pressure. It is coming from the market's recalibration of external information, the news, the macro data, the positioning elsewhere in the commodities complex. A zero-volume move in a prediction market is, in some ways, purer than a volume-driven one. It tells you the collective assessment of the market has shifted, not because traders rushed in, but because the weight of new information tilted the equilibrium without anyone needing to transact. 13% remains a minority forecast. But a minority forecast that is accelerating from 11 to 13 in a single session deserves attention from anyone positioned in gold or gold-correlated instruments. The smart money flow signal on this contract is registering a net buy. In the architecture of prediction market analytics, a smart money indicator isolates the directional behavior of historically accurate forecasters, participants whose track record across multiple markets and multiple cycles exceeds the baseline by a statistically significant margin. When that cohort registers a buy on a 13% probability contract, it does not necessarily mean they believe gold will hit $5,100 in May. What it means is that they believe the market is underpricing that possibility. 13%, in their assessment, is too low. Consider the implied ratio. A contract at 13% assigns approximately a 7-to-1 probability against the outcome. The smart money read suggests that ratio should be closer to 5-to-1, perhaps 4-to-1. The difference matters enormously for anyone positioned in gold options, gold futures, or gold-correlated equity. If the macro environment, persistent inflation expectations, a Federal Reserve slower to cut than markets hope, continued geopolitical pressure continues to tilt in gold's favor, 13% has significant room to run. The smart money cohort appears to be positioned for precisely that eventuality. Place this in historical context. 18 months ago, $5,100 per ounce was not a price target any serious macro analyst would have published without significant qualification. Gold was trading in the mid-2000s. The trajectory since has been extraordinary. A combination of Federal Reserve policy uncertainty, persistent above-target inflation across the United States and Europe, dollar reserve diversification by BRICS-aligned central banks, and the longest sustained period of geopolitical instability since the Cold War has compressed the timeframe for what was once considered an extreme scenario. The historical precedents are instructive. In 2011, gold peaked at approximately $1,900, a level that had seemed impossible at the start of that decade. In 2020, gold broke above $2,000 for the first time, driven by pandemic-era monetary expansion and ECB and BOJ coordination. In 2024, it surpassed $2,800. Each ceiling, once broken, has become a floor. The $5,100 question is not whether gold is structurally capable of reaching that level. The structural case is broadly established. The question is timing. And prediction markets are among the very few instruments that price timing directly. 13% for May implies the market understands the thesis. The debate is whether the catalyst arrives within this particular calendar month. What should macro investors be monitoring in the sessions ahead? Begin with the Federal Reserve. Any signal from FOMC communications, whether in the minutes, in speeches from board members, or in the next rate decision itself, will carry an outsized effect on both Treasury yields and gold's safe haven premium. A Fed that signals patience in the face of stubborn inflation is the most constructive macro backdrop for gold. Watch CPI carefully. The next United States Consumer Price Index release will either validate or undermine the inflation persistence thesis that underpins gold's current strength. A hotter print accelerates the case for 5,100. A cooler one may give pause. And do not discount geopolitics. Ceasefire negotiations, sanctions regimes, NATO posturing, and OPEC production decisions are not peripheral to the gold trade, they are central to it. Central banks within the BRICS bloc are not accumulating gold because of what the Fed signals. They are accumulating it because of what the broader geopolitical architecture implies about the dollar's long-term reserve role. The $5,100 contract resolves at month's end. The prediction market says 13%. Smart money says that number is understated. If you are tracking this space, subscribe to this channel and we will follow every catalyst as it develops.